All right, guys, I think we should get started because it's gone after 6. So, hello, my name is Jody Hernandez. I'm going to start off by just giving you a little background about myself and the company that I work for. So, I am a relationship manager here at First Line Securities. I've been here now for the last 4 years. Before that, I lived in London for around about 14 years. I did all my studies over there. When I got there, I started off working for a bank called Halifax, which later became Lloyd's Banking Group. And I spent my entire career there. I started off my entire career in London there. I started off as a cashier, and then I worked my way up doing mortgages, loans, and then finally financial advice. I studied there as well in the UK. So I studied at Birkbeck University. I did my degree in financial economics, and I did it part-time while I was working. And then eventually I moved to Trinidad and started with First Line Securities. And yeah, I've been here since for the last 4 years. First Line is a company that mostly deals with savings, investments and corporate financing, and also trading. So that's just to name a few of the main things that we do here at First Line. All right. So today we're gonna talk about budgeting, savings, and investing. We're gonna look at hopefully tools that would get you to be on the right path towards savings and investing. So the aim of the presentation today is to provide each of you with a path to start lucrative investments regardless of your financial circumstances. So we'll first look at how you can start to build a pot that you're able to then put into some sort of investment and start to reach your financial goals. All right. So I have some guidelines here that I want you guys to abide by, please, just to make the transition or the event a bit smooth. So let's go. I will advise when you can ask questions. So what I will do is throughout this segment, if I see that there opportunities to ask questions, and I'll ask if there are any questions. To ask questions, you can use the raised hand icon, and when called upon, you can unmute your microphone to ask questions. During the presentation, you can also ask questions via the chat, and I will answer when I can. So when I have breaks in between, I will answer. If you can, please keep your microphones muted after asking a question to help keep the background noise to a minimum. Make sure you mute your microphone when you're not speaking. Be mindful of background noise, anything going on around you. When your microphone is not muted, avoid activities that could create additional noise, such as shuffling papers or typing on the keyboard. You can make it easier to focus on the meeting by turning off notifications, closing or minimizing running apps, and muting your smartphone. All right, so I hope that's clear. So let's get started. All right, so pathway to investing. So we're going to look at, I've broken it up into 5. We're going to look at budgeting, saving for an emergency fund, repaying debt, saving for planned spending, and then finally getting to being able to comfortably invest. Budgeting. So I have a little poll for you to do. So the questions, your answers are going to be anonymous. So you don't have to worry about, me seeing who said what. So you can answer honestly and let me know your thoughts. So the first poll before we go into budgeting, I wanted to find out. So it's how do you monitor your spending? All right, it's close. So let's see your answers. How do you monitor your spending? Mhm. Do you have a monthly budget? So let's see. All right, so poll closed. 20% said yes. 52% said no. 52% said sometimes. And then how many said no? 20% said no. All right. So it's not a fixed thing that you do. So before we go any further, I wanted to explain to you the difference between monitoring your spending and budgeting. So monitoring your spending is just knowing how much you spend. So it is basically knowing that at the end of the month, X amount goes out to gas, X amount goes out to bills, X amount goes out to entertainment, but not really making a conscious effort or a conscious decision to decide, I will only allow X amount to go out for entertainment. I will make sure that my bills are X amount. So budgeting is having a defined amount and deciding that this is what you're going to stick to, as opposed to just keeping an eye on what you're spending and knowing what you're spending. So what I found is budgeting. Now, when you listen to a lot of these financial programs and financial advice, they tell you take 20% and put it towards your savings. Your bill should only come up to X amount. And at first, when I started to do my personal budgeting, I found it really, really difficult to stick to. And then what that meant was failing to reach up to my budget or failing to maximize my budget plan. So that caused a lot of problems in that eventually I got fed up and tired and I said, oh, I can't do this 20% or whatever. And my budgeting fell by the wayside. So over the years, I've realized there were certain things that I needed to do every time my circumstances changed. So my circumstances would have changed when I moved from England to Trinidad. My circumstances would have changed when I moved from my parents' house out on my own. My circumstances would have changed when I had my son. So each time I had to monitor my spending and monitor my budgeting in a different way. So these are the things that I found helped me. Take a detailed account of your spending for a few months. So by that, I mean record absolutely everything. So you can do it by maybe checking to see what is your spending on your credit card. So what I did for a couple months was I started to spend everything on my credit card. So if I needed to go to get gas in a gas station, I would purchase it using my credit card. Every time I needed to collect groceries. And then what I did was I collected all the information at the end of the month and I looked at my credit card my credit card statement, and that helped me understand what I was spending every single month. Another thing, you can use an app where it shows you what your budget is. And what I want you guys to be mindful of is that you're not going to figure out your spending patterns for a good few months. So it took me between 4 to 5 months to be able to understand what my spending pattern was. So it took me 4 to 5 months to understand, well, okay, I comfortably spend about $3,000 on entertainment. I comfortably spend $1,500 on gas to take my son to school and for us to go and for me to get to work. So it took me about 5 months to figure out that pattern. So what I'm saying to you is take your time, figure out what your pattern is, and then you can understand what you're comfortable spending and what you're comfortable putting aside. Make small allowances for things that may unexpectedly occur. So for myself, for instance, after I've completed my budget, I'll take $1,000 and I'll say, okay, this is going to be put aside just in case something happens. So just in case my son has to go to a birthday party that we didn't budget for, we didn't plan for, just in case my tire got a hole and I needed a brand new tire. So I would always take that $1,000. So always have an allowance for the amount of money for unexpected things that might crop up during the month. Your budget is something you should do every month. So this is why sometimes I find it difficult to subscribe to this. I'm going to save X amount, 30% of my savings every month, because your budget is something that could potentially change every month. So before you get your income, do a budget and plan out what your spending is likely to be. If you can avoid paying for unexpected expenses, wait until your next payday and then budget for it then. So an example would be the mirror. Somebody hit the mirror of my car, so it just got a bit damaged. I could still see through the mirror. I knew I had to fix the mirror, but I decided, you know what, I didn't budget for this mirror this month, so next month I will pay for the mirror. So things like that. So try to push it until the end of the month and then do a budget and include what your spending is for that budget. What your spending is for that month, sorry. Decide what you're going to sacrifice or cut back. So once you have taken a detailed account of your expenses, and you know that there's things that you could potentially cut back. So if, for example, you know you're spending $600 on your phone bill, you might decide, okay, hang on, do I really need to be spending $600 on my phone bill? You know you spend $3,000 on entertainment. So you must, so when you're actively budgeting and you're looking to save and you're looking to invest, you must now start to decide, okay, what are the things that I'm going to put aside and the things I'm going to decide that I'm not going to spend on, or I'm going to reduce my spending on, and stick to it. And what may also help you is do it weekly. So you decide that you're going to spend $3,000 in entertainment, split it up weekly. And that would be really useful. All right, so building an emergency fund is the next step after you've budgeted, after you've decided, okay, I have a couple thousand free every month to put aside, or 3,000 free to put aside for savings. Investing is not the next step. So you don't decide, well, okay, fine, I have a few grand extra, let me put it towards some sort of investment. What you need to do is build an emergency fund. And it's so interesting that COVID happened recently, because to me, that enforces the idea of having an emergency fund. Picture that, let's say, let's rewind a few months. Let's go back to March when COVID happened. And some of us may have lost income in some form or fashion. So whether it be that we lost our jobs, whether it be that our salaries got cut, we could have suffered from some kind of financial loss before that. And if you had, let's say, your only savings were tied up in investments and they were tied up in the stock market, they were tied up in shares, what happened after COVID? The value of shares had gone down. And if your only source of savings was to go into your investment and withdraw, you may have incurred penalties. You may have suffered from having lower stock prices, so the value of your investment would have gone down. So with all that's happened recently, it reinforces the point that an emergency fund is important. When building your emergency fund, it's important to know your expenses. And the general rule of thumb is that your expenses should be, your emergency fund should be at least 3 months worth of expenses, so that you're able to comfortably live without having to dip into other savings and other investments that may be tied up, that may have dipped in value. So the whole point of the emergency fund is to safeguard the investments that you would have already had or the investments that you're building. So we must have the safety net in place first before we start to build the investments. So a lot of times people ask me, okay, well, where should I keep this money? If I leave it in the bank, it's not making a lot of money. What if I don't have an emergency in another couple of years? Then that's fine. What you do is you find an investment, or you find an account that is giving some return, and this is where you have to do your research. You have to see what the returns are like. Now, there are some companies, some banks, unit trusts that offer investments well, no, I shouldn't say investments, they offer savings opportunities that are secure. So your emergency fund should go somewhere that is secure. And they also offer investments or savings that are easy to access. So in the event an emergency does occur, you have easy access to these funds, and they should only really be used for emergencies. So you really have to decipher for yourself what is an emergency and what is not. So buying a new handbag is probably not an emergency. So make sure that it's something that really warrants you having to go into your emergency fund. What works for me, where I hold my emergency fund, is I put it somewhere where I don't have a card to access it. So if I needed it, I would go into I'd need to go and queue up and line up in a bank and take it out. So while I know that that's not instant access, it still deters me from taking it out just because my budgeted money for the month is running a little bit low. So that is my advice for you. So somewhere where an account where it doesn't have a card, an account where you can access within a day or two, and an account that is giving you some sort of return. So leaving it into a normal bank savings account is not the best. I would not advise, would not be the best idea. Paying debt. So once you have built your emergency fund, so the third course of action needs to be repaying revolving debt. Now, I mentioned revolving debt here because revolving debt is different to if you have a fixed debt payment, it's like a mortgage or a loan. So a fixed debt payment is a lot more controllable. It is in a fixed period of time, whereas a revolving debt, you can continuously use your credit card, and that debt can grow and grow and grow. So sometimes you hear people saying a credit card is the devil. If you don't have control over it, that potentially could be the situation. All right, so revolving debt is what I'm referring to here. A credit card, overdrafts, these are the costliest form of debt as well. So they tend to be up in the 20-something% in terms of interest that you're paying back, or the cost of it. So if you have debt after you've budgeted and you've put aside an emergency fund, everything in excess from your budgeted fund should go towards paying off that debt and getting that credit card or overdraft under control. So, emergency fund built, credit card repaid. So now we need to look at planned spending. So there have been quite a few occasions where I have spoken to clients and they've said to me, look, I want to buy a car in the next couple of years, and I'm thinking about putting this money so that it grows. I actually had a client last year who wanted to further education, and she had a nice little pot of money, but she wanted to do it. She wanted to go back to school in 18 months. And she said to me, look, I need you to put it into a nice investment and let it grow so that I can take it out in 18 months. So the risk with investing in such a short period of time is that you are not giving your funds enough time to grow. So if we put it in an investment that there is fluctuation or there's risk attached to it, you must be able to allow that money time to grow and to recover if in the event anything happening, any economic or financial downturn, it must not be a situation where you need to take this money out at a set period of time, and therefore, if the value has gone down, you have to suffer the losses. So that's why when it comes to investing generally, it should be money that is in an account for 3 years, or money that you don't plan to use for at least 3 years. So that's why it's important to make allowances for your planned spending. So put aside money for your planned spending of the short term, which is typically 3 years or less. Would you like to buy a car or a house within the next year or 3? Then what we're calling that is planned spending, and that is where your savings will come in. So this will take planning. So decide how much money you'd like to spend on each item. Calculate how much money based on your budget and time horizon you'd like to put towards these goals. So an example of that would be, say for example, you wanted to purchase a car. You decided that you wanted to purchase a car within the next year, and you have $1,500 left over every month. This is just a plain old example. And you decided, okay, I'm going to put this $1,500 away every month, and then I'm going to decide how much I want to, and then I'm going to decide on taking a loan to purchase this car. So you put this $1,500 away for the month. After a year, you get $18,000. So you know that you're comfortable. So first of all, you've tested yourself, because you know $1,500 is a comfortable amount for you to put away every month. You've built up a small deposit for your car. You can now go out and take a loan. But what you must be mindful of is whatever the loan amount you take out is a comfortable amount. So it would be a wise idea to replace that $1,500 savings with the loan amount, as long as you know that that is not going to be a struggle for you to pay that $1,500, and you will still have money left over for your savings. So then you know that you can afford a car for around $70,000. Well, the loan would be about $70,000 if you take it out over a 5-year period. So you know that you can afford at least a $90,000 car, right? So all of this needs to be planned into your investment plan. So making sure that you have a clear idea what you want for the next 3 years in terms of financial goals. So just little things like if you want to buy a car, if you know that by next year you might want to upgrade your phone. So things like that included in your overall plan for savings and investments, right? And then once you've done that, find a savings plan or an account that is low risk as well and offers competitive returns, because you know that you're going to take this money out within the next 3 years. And I say a savings plan because you want to find something that you're easily able to deposit money into. So whether it be a standing order, which is the best form of saving, it's getting that money coming out directly out of your salary or your income and going directly into your savings account. So get to set up something where it's a fixed amount coming out every month until you're ready to make your purchase. All right, so I'm going to pause here. Are there any questions so far, or need me to go over anything at this point? Somebody asked, what would make a bank institution insecure? So I need a little bit more explanation on that question. Hmm? I think the question is from What's Your Duke? What's your, you want to explain a little bit what you mean by insecure? Right, so when I say secure, I mean low risk. So we'll go through the different levels of risk. So yeah, we'll go through different levels of risk and then a little bit later on so you can understand the different levels of risk. But not secure was probably not the most perfect term, but what I did mean was a low risk savings account. Does that make sense? So when I look at the returns across the board, you could get for something that is that you're not going to dip into regularly and doesn't have a card, you could get around about 1.5%. So it's not a fantastic return, but it's better than if you just left it in a normal deposit account where you're getting less than 1%. So there are accounts that you can get, that you can have access to, that you can get between 1.5% and 2.5% actually from your different institutions. So I know some of the institutions do mutual funds where none of your capital, your initial investments are at risk. So you can check out some of the mutual funds from the banks and stuff where you can get that kind of return. Right, so one of the questions was, would it be advisable to save your emergency fund in a credit union? And I absolutely think so, especially if you know that eventually you're going to get some form of loan. A credit union is a great place to save. Once it's a credit union that you're comfortable with, it's a good place to save. Their rates tend to be a bit more competitive than the banks, and they tend to be low risk attached to most of their deposit accounts. Right, so when you're doing your research, you should look for the annual return. So you need to make sure that it's the same kind of investment that the same kind of savings that you're looking at. So make sure, so if one company is calling something a deposit account, make sure that when you're comparing different rates, that when you go to another institution, it's also being called a deposit account. And it's not an account that is investment based or stock based or share based, where your capital could fluctuate and change. So make sure that the names sound similar. So some companies might have what we call a money market fund. If you're comparing a money market fund for one institution, make sure when you go, you're asking for rates, you say, I want something similar to a money market fund and how it's structured. So just make sure that the names are very similar when you're comparing and you're looking at the annual return. A lot of companies will give you the first 1 year's annual return, 3 years, and 5 years. So those things are good to look at, the patterns in terms of returns. But a lot of these low risk savings accounts just give you fixed returns overall. But I will underline again, the most important thing to ask for is when you are comparing the names, just make sure it sounds similar. So most places have a money market account, normal fixed deposit accounts, that sort of thing. So the question that I had, another question is, would I say emergency fund is more important than paying off debt? And I would say yes. I would say an emergency fund and I have seen it in my life where I was about to pay off my credit card and I was pretty happy that I didn't. So I had access to funds because something really important came up. And I think an emergency fund gives you a sense of security. So I definitely think that it should be priority, but once you have enough, and I think 3 months worth of expenses is enough. I mean, obviously things are going to crop up that are varying, but I think once that's done, you have a sense of security, and then you can put everything in excess. After that, all of your monthly excess, you can put it towards paying off your debt. All right, what are some of the institutions that I would recommend for savings and gaining returns? If it's just a normal savings account for your emergency fund and for your planned spending, credit unions, as I said, are good because there's the possibility of building a relationship with them and then later on in life getting access to loans and mortgages and things like that, and that's important. So that is one. And then looking at there's some companies that offer mutual funds that are pretty low risk, that give you a guarantee in terms of easy access, that give you a guarantee in terms of capital, that nothing will happen to your capital if anything which happen in the market, that your capital is protected to an extent. So those are the kind of institutions I would look at. And then you have your unit trusts and etc. The next question is, how do you budget if your salary isn't a fixed amount every month? And that is a great question. Then now it all depends on when you get your money. So what I did, because there was a point in my life where I didn't have a fixed salary for a very short period. And what I did was I accumulated enough. So for the first couple months, I accumulated enough so that my bills were prepaid. And then I had 1 month where there was a sort of a lull in my spending, where, well, there was a gap in my spendings because all of my bills were prepaid for 1 month. And then within that month, I was able to say, okay, this salary that I'm going to get at the end of this month, I've already prepaid. So this salary is going to have to be budgeted for the following month. So it all depends on how you get paid. So if you get paid weekly, then you try your best to pay your bills 1 month in advance or 1 week in advance, if that's how your bills are sectioned off. You try to pay it in advance, and then you have a period of time where you have no bills, and you take that period and you dedicate that income to the following month. So every month, you're 1 month ahead of your payments. So you're able to budget for the following month. So if for example, just to make sure that I'm clear, if for example, you're able to pay, so let's say you have your emergency fund, something happens and you've lost your job, for example, and you've gone into self-employed and you only get payments as jobs come in or as days go along. You take an emergency fund, you pay off your bills for that month while you accumulate all the saving, all the income that you're getting for that month. Let's say you've accumulated, figure out 10,000 for that month, then you know that your budget is now 10,000 for the following month, that you're able to pay your expenses, so you have to be a lot more in tune with your spending, and you have to be a lot more in tune with your income to be tracking it all the time. There are a few more questions, but we'll answer at the end, just so I could move on to the next section. All right. No, actually, no. All right, so I want to do another poll. So this poll is, I want you all to identify what you think is an investment as opposed to what you think is normal savings. So there we go. If I put money in a mutual fund, is that a investment or a savings? All right, polls closed. All right, so 62% said a mutual fund is an investment, and 38 of you said, no, it's not an investment. So a mutual fund can be an investment because a mutual fund is built with mostly stocks and bonds, which are investment vehicles, right? So the value of these funds can fluctuate. Now, what you have because mutual funds are so common, what you have with some mutual funds is the provider of the mutual fund could potentially say to you, well, okay, it is a mutual fund. The return that you get will fluctuate, but your capital may not fluctuate. So these are considered low-risk mutual funds, and they are plentiful on the market. So they're basically saying to you, the return could fluctuate with regards to the investments within the mutual fund, but your capital may not. And then there are mutual funds that will fluctuate with the market. You will see dips, it goes below your capital. So yeah, a mutual fund will be considered an investment. Now it's, would a fixed deposit be considered savings or investment? Right, so yeah, so most of you said no, a fixed deposit is not an investment, and you're totally right. So a fixed deposit is a way of putting your funds away with a fixed rate of interest. If you go to a bank or a credit union and they're offering you a fixed deposit, it is simply saying, we promise to hold this money for you over X amount of time while we pay you back X amount of interest. So there's no investment into anything else. It's just deposited there, and they're promising that while we hold it for you, we will give you an interest payment for that. So no, not an investment. All right, so the next question was on a government bond. Is a government bond an investment or not? All right, so 76% of you said yes, and it is. So a government bond is an investment because it is outside the normal realms of a fixed deposit. Now, government bonds are one of the most secure investments. So you'll hear people talk about treasury bonds. Those are what government bonds are. They are of one of the most secure investments, but it is outside the box of a normal bank account and a normal savings account. It is in essence very similar to a normal fixed deposit account in that you're lending money to the government and they're giving you back a fixed return over a set period of time. But the difference with government bonds is that they can actually be traded. So you can have it for a 3-year period, but within that, decide that you no longer want it and sell it within that period of time. And that is where the bit of fluctuation could occur, because it could be valued less than what you originally bought it for. So yes, a government bond is an investment, but considered a secure investment because it's backed by the government. So the next one is shares. Do you consider shares, buying shares or stock in a company, an investment or not? Yeah, so most of you guys got this one. So 96% of you said yes, you consider it to be an investment. And the rest of you said no. And yes, shares are most definitely an investment. So let's look. Oh, so wait, one more. Right, so the final one is cryptocurrency for those of you who are familiar with cryptocurrencies, investment or not. Yeah, so 84% of you said it's an investment. Now, cryptocurrency is a bit of a tricky one because the jury is a little bit out in it because there's not enough history for us to tell any patterns with cryptocurrencies thus far, any sound patterns. Like there are people who speculate a lot. There are people who try to do a bit of analysis. From what I've read, most people get it wrong. So there's a large amount of people out there who believe that cryptocurrencies are more of a gamble than a thoughtful investment. So the jury's out on that one, but it's definitely not a form of savings. There is fluctuation involved, there is risk involved with cryptocurrencies. So yeah, so I prefer that the answer of yes, it being an investment as opposed to no. All right, so savings, let's look at savings versus investing, or investing versus savings. So savings is simply accumulating your funds. And this is why I would say to you that if you want to build an emergency fund and you want to build your fund for planned spending, that is simply taking a set amount of money and putting it aside for the rest of the month. However, investment goes a little bit deeper, and it's giving your money the opportunity to grow and generate profit. Now, you may ask yourself, okay, well, why would I want to invest over wanting to save? So the first reason that you'd want to invest over wanting to save is the risk of inflation. So I call inflation a risk because inflation basically eats into the purchasing power of your money. So inflation is a change of the price of goods and services. So if you think of normal, how we calculate inflation, if you think of the normal way that we value goods and services, so things like food, your bread, your milk. So what they do to calculate inflation is they put together a basket of these things, your bread, your milk, your eggs, typical things that a household would use, as well as services that a household may use. And then they calculate what the change in the price of that has been, and that's where you get your rate of inflation. Now, as inflation goes on, it reduces your money's purchasing power. Now, here in Trinidad, over the last 30 years, inflation has gone up an average of 2.4%. Now, it's varied drastically in Trinidad. So there's some years, such as 2006, that inflation went up all the way to 12%. And there's some years, just 2019, last year, where it was as low as 1%. But we worked out that over the 30-year period, if we looked at an average rate and we evened it out, it would be about 2.4% for the last year, and for the last 30 years. And what that means in financial terms is that 30 years ago, in 1990, if you had a $100 bill and you purchased $100 worth of goods, you can only buy $53 worth of those same goods 30 years later. So the value of the money has actually gone down if it's not earning interest, so it's not getting growth. All right. So what I want you all to recognize here is if inflation is growing by 2.4% every year, and you have just dumped your savings, your long-term savings into a normal deposit account, then it means, and it's not growing by more than 2.5% a year, then it means that inflation is actually eating away at your funds, and you're doing yourself a disservice because the value of your money is not growing. So inflation is one of the biggest risks that you can have for your money and for your savings. So it's always important to beat inflation. Also, another reason for investing are your long-term goals. So especially things like retirement. And it's important to make sure that you're putting your funds into something that is building a nice pot for you for retirement, especially if it's going to be a long-term savings plan. So I know most of you are far away from retirement, probably something that you've not given too much thought about. So I wanted to show you some examples of how effective saving for retirement can be. So say for example, you have decided that you wanted to save $1 million up until retirement. And let's say you're between the ages of 25 and 30. So you have another 30 years to accumulate your retirement pot. Let's see, a nice healthy retirement pot. And you decide, okay, I'm going to save $1 million and then I'm going to invest. When I get to my 55 or 60, I'm going to invest that and that's going to breeze me through retirement. And let's say you walked into a normal bank or normal credit union and you say, okay, look, put $1,000 there every month and that is going to be my money towards retirement. Now, if I'm telling you that inflation is 2.4%, then after that 30-year period, your funds are not going to grow to that $1 million at a 3% rate because you're pretty much barely skimming the top of inflation. So your funds are going to grow for about 500. It's probably going to grow to about, it will grow, sorry, if you put $1,000 a month, to about 580,000 over that 30-year period. All right. So then you start to see the big difference if you start to invest. So if you put your money into, like, let's say a modest investment that is fairly conservative and it's managed to return you at least 7% over that 30-year period, and you've put that $1,000 every month, then you're likely to have a return of over $1 million. So this shows you the value of investing and the value of maximizing the returns that you can potentially get from your hard-earned money. All right, so let's take a few questions right now. So because now so a question was, is it smarter to become involved in government bonds or mutual funds? So there's different levels of risk attached to them, right? So and it all depends on what you're saving for. Excuse me. It all depends on what you're saving for. So if you know that there's a government bond available and it's for 3 years and it's giving you X amount of return, and you know that in 3 years' time that money is earmarked to purchase a property or purchase a car or make a big expense or make a big purchase, then the government bond is a sure return. You know, you can budget, you can calculate exactly the kind of return that you're going to get back. Mutual funds, the returns vary. So you can't go into somewhere and they have a mutual fund and they say to you, oh, I guarantee you will get back 3% on this mutual fund. So it varies. So it all depends on what you're investing in. However, a mutual fund may give you the potential for greater returns than a government bond because it's not fixed. It's not set in stone. So you are actually giving up interest for that guarantee of X amount of interest return. So that is what you need to bear in mind. So it all depends on what you want to do. All right. So here, oh, sorry, no, let me take a couple more questions. All right, so the next question is, how do you get to be part of a government bond? So you can go through a broker and you can make purchases for a government bond. So there are a few companies that you're able to purchase bonds, shares, and those types of things via a broker. So that would have to be your action. Right, so the other question is, most credit unions ask for a job letter to join. And if you've lost your job, then that would be a bit difficult to get a job letter to join. So how else can you allow your money to grow? Now, because of compliance issues, most financial institutions will need some source of funds. There are some that will bend because if you don't have, so for example, here at First Line, we would just ask you for a source of wealth. So you're basically declaring to us, this is where the funds would have come from. You can show us maybe a bank statement to show that you've been accumulating this money over some time. So some institutions will allow things like that if you don't have a job letter, if you don't have a pay slip. So you just might have to do a little bit of investigation as to where, who will be a little bit more lenient, because there are institutions that will, but it's important for them to be compliant And the whole point of asking for a job letter is to show that you had the means at some point to be able to build up this savings. All right, so somebody asked, should you ensure that you pay your credit card monthly even though you haven't amassed your full 3 months of emergency spending? Absolutely. Ensure that you're paying at least the minimum payments on your credit card while you are amassing your emergency funding. There are important reasons why you must make sure and do that. And the first one being protecting your credit score. So you have to make sure that you are at least paying your minimum payment. I like to pay, I would definitely say pay a few hundred above that if you can, maybe a couple hundred, because right now your focus is building your emergency fund if that's where you're at financially. But definitely make sure that you're never late on your credit card payments, and that goes for loan payments if you have any outstanding as well, because it affects your credit rating and your credit score. And your credit rating and your credit score become extremely important when applying for loans and mortgages as well. It becomes important when negotiating a better interest rate. So you must also always make sure not just to pay it, but to be on time. All right, so I'll take one more. Not necessarily. The question was, are you saying that credit unions are better in terms of rates for mortgages? Not necessarily. That wasn't my experience personally. So it all depends on what's happening in the market at this time. But what I'm saying, right? So what I'm saying, so for example, because of everything that's happened and because the bank recently reduced their lending rates, the banks may be cheaper right now. So, but what I'm saying with union is that it's important to build a relationship with them in the event that you need to use them at any time. It becomes easier that if you go to them and you have a relationship with them, that you're likely to get a loan. So just having a small amount, even if you just hold your emergency fund there, that is starting to build a relationship. But don't let that deter you. If you don't have a relationship with another institution, don't let that deter you from shopping around the institutions that you're not banking with when you're ready for a mortgage payment, when you're ready for a mortgage. But shopping around is important. Make sure and check who has what deals. So there's a question, how do you find out your credit score? So this, and you know, I did a blog on this maybe about 2 years ago. But I don't remember, but I can send you the link to where you go because I don't remember off the top of my head, but you can actually get your credit score done. How I got mine last time is when I went to apply for my credit card, I got they were able to give me a copy of my credit score as well, but you can apply for it independently. So what I'll do is I'll find out for you and then I'll send it via probably email because I have everybody's email address. All right. Thank you for those questions. Very good questions. So we're going to do another poll before we move on to the next segment. So this one is comparing, well, what you think is more risky. So first one we're going to do is cash versus bonds. So cash as in keeping cash under your mattress or keeping it into a normal savings account versus buying a government bond. Okay, so 56 people said cash is more risky and 44%, sorry, 56% people said cash is more risky and 44% people said bonds are more risky. So this is an extremely interesting perspective. So generally, leaving your money in a deposit account or in a cash account where you have instant access to it or leaving it under your mattress is generally considered in the investment world the lowest of risk, right? but everybody's going to have a different opinion on this. And my opinion is if you're leaving money at home in Trinidad, you can get burgled, right? So I think that that is extremely risky, and not to mention the lack of growth. So inflation is eating away at that money consistently as it's sitting there not growing. And $100 in January is not going to be able to buy you the same amount of goods in December. So that's something definitely to be mindful of. But something to be mindful of, but definitely it should be something to think about, especially leaving cash at home. But generally speaking, cash is supposed to be lower risk, holding on to your cash. Right, so the second one we're going to do is shares and mutual funds. All right, so 83% of you said shares, and the rest of you said mutual funds, and that's absolutely correct. So even while mutual funds will have shares in them, and they will be backed by shares, there's a lot more diversification. So if you purchase shares from a company on its own, that is higher risk than if you go and you put money in a mutual fund, which is spread over several investments, which include shares and bonds, right? So yes, you're right. Okay, so unit trust versus government bond. All right, all right. Oh, so this was almost split in the middle. 46% of you said unit trust, and the rest of you said government bond. And I could see where the confusion could be. Well, where you can think that, because when you think of unit trust, you think of our regular unit trust corporation where you can put money in and take money out. But generally speaking, government bonds are lower on the pool, on the risk pool, because governments are meant to be, when something is government backed, it's meant to be more secure, because generally, if something happens to any of these companies, so whether it be any of the banks, unit trusts, or any of these companies, government does guarantee you, they're the ones who can bail out the banks and bail out these companies, and they give you some sort of guarantee from your financial services compensation scheme. So yes, so it should be that that government bonds are more secure than unit trusts. The final one is if you decide that you want to put your money into real estate, purchasing a house, or shares. So 23% of you said real estate is more risky, and the rest of you said shares is more risky. So this again is something that is a common belief, that it is less risky to put your money into property. Now, what shares offers you that really, well, what purchasing share offers you that real estate doesn't offer you is two things: accessibility. So it's a whole lot easier to take your money and decide that you're going to purchase a bunch of shares than it is for you to purchase a property, which can take months, which can take time, and it also offers you the ability to do it with a small capital. So you don't need a large amount of money to be able to purchase real estate. Sorry, to purchase shares, but you do need it to purchase real estate. So yeah, so with that one, the answer is real estate is more risky than shares. So I have here a little pyramid for you, and it's the investment risk pyramid. So what I want you to be mindful of is the relationship when it comes to investing is the lower the risk, the lower the reward. The higher the risk, the higher for the potential rewards. So you'll see right at the bottom there, cash and term deposits. So when I talk to you about fixed deposits, that's at the bottom of the table. And then we go to bonds. And within those bonds, we have government bonds, but then we also have company bonds. So while the government can agree to lend you X amount of money for a fixed period of time and pay you a specific rate of interest, companies can do the same, and you can have company bonds. So if government bonds offer a certain level of risk and reward, company bonds will offer a higher level of risk, but the rates are likely to be better. Medium risk would include your managed funds, your mutual funds, and your unit trusts. So that's where the mutual funds will be a bit more risk than the bonds and the fixed interest securities. And then shares are above those mutual funds because, again, as I said, the mutual funds offer more diversification. So you're able to benefit from the growth of several different shares and bonds. And then finally, we have derivatives, which are a whole different ball game. So the value of these derivatives are derived, they come from underlying assets. So this is where the investments become a bit more complicated. The risks become more complicated, but the returns can be quite lucrative as well. Right, so we've talked about the different types of investments. We've looked at the different ways that you can invest. Now, what I've put up here is the 20-year return of our Trinidad and Tobago composite, which is our stock exchange here. So what this is, what the composite tells you, it's a figure that represents the growth of all the stock on the Trinidad and Tobago stock exchange. And by stock, I mean shares, equity, all of them are considered, that's what we consider stock. And what stock is the value placed on purchasing one unit of ownership within a company. So if I buy one share within a company, then that's my level of ownership in that company. So this is telling you what the prices have been of this stock over the last 20 years. So it's basically grown from, and the index has grown from 400 all the way up to about 1500. All right, so it has grown by about 350%. Now, there's a few things before we go into what you need to be mindful of. So it's grown by at about 350% over the last 20 years. So the reason I wanted to show you guys this graph is because I had a client just today ask me, well, is it a good time for me to invest in stock? What this graph tells us is it's more or less always a good time if you're looking for a longer period. So that is why when people are looking to invest for retirement or looking to put money aside for retirement, it's always wise, as long as you have a 5 to 10 year or more period before you have to retire, to put money in stock, because you've seen that over that 20-year period, while there have been ups and downs and it's fluttered around, eventually it levels out and it grows, and it's grown by 350%, where you're not going to get that in a normal savings or deposit account, and you'll be hard pressed to find it as well in any kind of mutual fund or bond as well. So this is what this graph is meant to show you, that over the long run, the returns tend to be greater, while there are going to be fluctuations in betweens and there are going to be dips, and the return tends to be longer. And also to drive home the point to you as well, this is why it's important to have an emergency fund, so that in the event of emergencies, you're not dipping into your investment. You can allow it to grow, and even when it's on its down periods or when it's on the lower end of the graph, you will give it time to recover and then withdraw. So that's why it's always important to have time when you're investing. Now, there are a few things that you guys need to know that it's important to know about our particular stock exchange. So that everywhere in the world has a stock exchange. So the US, well, there are a lot of different stock exchanges, I should say, that are popular. Now, ours is fairly small. There are only 24 companies on the exchange. It's relatively illiquid, and what that means is that it's not as easy to purchase stock. So what you have to do in most cases is, if you decide that you wanted to buy stock on the stock exchange, and our Trinidad and Tobago Stock Exchange, you're going to have to wait until somebody's willing to sell it at the price that you're okay to buy it. And that could take time. And that's what illiquid means. It means it's not a quick transaction because there's not stock just floating around waiting to be bought or sold. It's measured by the composite index, which are the figures that I would have, these figures on the left-hand side here. That's the index, that's the measurement of the index, and that basically shows the growth. And it's skewed by major players. And what that means is that of those 24 traded stocks, 75% of the stock exchange are made up by 8 companies. So that value that you're seeing in growth, there are 8 companies that have the bulk of the capacity within the stock exchange. So those companies are Republic Bank, Scotiabank, First Citizens, First Caribbean, Answer, Woodco, and Massey, right? So any one of those change in value, they would have a greater effect on the stock exchange than any other any other company that has less of a weighted average on the stock exchange. All right, so I'll take a couple of questions here now. All right, so this is one of the questions. I was really young when the whole Clico fiasco happened, so I don't understand what occurred. But I just recall that a lot of people lost their money, I think. So if you can remember, what was the issue in that scenario, and how does it compare to the conversation now of finding something low risk, secure, good returns, or was that just an anomaly? So with the Clico scenario, I wouldn't say it's just an anomaly. I think these things can happen. Now, the Clico, unfortunately, I was abroad, so I didn't get to experience the full brunt of what happened with Clico. And what most people tend to do is, when you're looking at investments, it's important to look at the history of the returns of the company. So those things are good so that you understand what kind of potential returns that the company has. But it's really difficult because I think Clico was a shock for everybody. I don't think it was easily predicted that scenario would have happened. The government did step in and they tried to salvage as much as possible as they could in terms of investors' money. But it's really difficult to kind of gauge if that is going to happen. Whether it's an anomaly, I guess it's fair to say it is, because if you think about in our lifetime, there weren't really other situations that occurred like that. So I think it's fair to say that, yes, it could be. I remember in the UK in 2007, when the financial crisis happened, there were a lot of banks having issues and having problems, and then the government came in and saved the day. So there are some checks and balances in place to make sure that these things don't happen. What you can do is just check the history of the company and check in terms of the past returns, and that's a good indication of what kind of returns you could potentially get as well. Right. So somebody also brought up the point that when we just go back to the real estate versus the shares, real estate is also riskier because it's not as tradable. So it's not as easy to decide, okay, I'm ready to sell this and get it off of my hands. It's a long process in finding a buyer, whereas you can just go on the stock market and find a buyer, put your stock up for sale and find a buyer. So good point. Thank you. Right. So the last question is, how do you invest in the stock exchange, and can you repeat the last 8 companies that are the major players in the stock exchange? You go to a broker. So most of the banks have brokers. Brokers, you can easily be able to invest in stock exchange through a broker. So you just need to type up an online brokers in Trinidad, stock exchange brokers in Trinidad, and you'll be able to find the one that's most convenient to you. The top 8 are Republic, Scotia, First Citizens, First Caribbean, Answer, Whitco, and Massey. Right, so just an added point on Clico. So Clico is offering extremely high returns and that were unsustainable. A takeaway from this scenario is that investing is not magical. So you can't expect it to be plant your seed today and tomorrow you have a huge tree in the backyard, is one of the major takeaways from that Clico scenario. So I guess, so that is something that you must consider in terms of finding out if a company, if the returns are too good to be true. So that's another thing that you must be mindful of. When something is too good to be true and it's too much, then that's something that you need to do a little bit further research and investigation. And also be mindful when a company tells you you can invest in it, you're going to get a high return, higher than the normal returns out there, and there's no risk involved. That is definitely a red flag when you get that kind of response. And that is the road Clico was going down. So there was definitely a mismanagement and, mis-selling and misinformation. Right, so somebody said they're 18, they don't get allowances, they don't work, and they only get allowances, and they wanted to just find out how they get their money to work for them with that amount, and they don't mind fluctuations. So in that case, as you have no expenses and as you are in a situation where you can put investments away and not be concerned about if it dips or if the value goes down, you can invest. You can open a stock brokerage account because it doesn't take much to do that. So it all depends on how much money you have, but you can open a stock brokerage account for $2,000 up, and then you can purchase stock through that way. All right, so we'll get to the rest of the questions after. So now we're going to go into which investment is right for me. So investing does not take a blanket, there's no blanket approach to be taken when it comes to investing. So you cannot, so what is important for us to remember is that 2 people will have completely different investment needs and investment goals, and we have to treat each person as an individual. Is really what my job is about. So the first thing I need to find out is somebody's personal risk profile. So I need to understand what is your comfort level in terms of investing, because it's all well and good you saying to me, look, Jody, I want to get back more than 3%. But then on the other hand, you're saying to me, but I want to make sure that you can guarantee my capital. So we need to make sure that there's balance in terms of what risk you're willing to take and what returns you're expecting to get. For me to determine your personal risk profile, there are a few things that I need to take into account. So I need to understand how you would feel when your money is fluctuating in value. Now, how I'm able to judge that, there's a questionnaire that I do, and that gives me an idea of how comfortable you are with those fluctuations. So it will ask you questions as like, if you have money invested and the financial markets had a crisis and you saw your money go down 20% in value, what would you do? So those kind of questions I will ask, and that will help me gauge what will your response be if something unfavorable happened, to help me assess your risk profile. Another thing that I'll have to take into account is your age. So somebody who's, as young as you guys, now entering the working world, now building your portfolio, I'm going to look at differently to somebody who's close to retirement. And I'm going to then look at that person even differently to somebody who's already retired. So your age and where you are in life will affect how I look at your personal risk profile. Which do you prefer, investable savings or a portion of your income? So it's really, again, this has to do with your investment goals. So we have clients who want to make investing an additional income stream. So they may say to me, Jody, I want every quarter to get money, to get the growth that I've gotten from my investment. And then we have people who like, okay, let's just leave it there, and I want it to grow continuously. So I'll have to tailor the investment around that, and that again will affect your personal risk profile. Your investment experience. So I've had several clients who would come in to me and say, look, I am high risk, I don't mind the fluctuations, I'm very comfortable with that. And then when I look at the fact that they've never experienced it, so this is their first time investing, they've now finished their emergency fund planning, they've now paid off their debt, and they're now saying, right, I'm ready to invest and I want to take maximum risk because I want my returns to be high. I would look at that cautiously. I would advise that you don't do that immediately, that you take a more moderate approach, feel comfortable with investing, feel comfortable once you see fluctuations, and then decide, okay, good, I'm fine if I see fluctuations, I'm enjoying when I see the highs, I'm comfortable to leave it there until the highs come, and then I'm ready to take out. And then your time horizon. So the amount of time that you have to invest. So if you're coming to me and you have a 5-year plan and you want to invest for 5 years to purchase your house, I will treat that plan different to how I will treat the money that you want to leave for 30 years for retirement. So all of those things are what will build your personal risk profile. So this is why I think it's important to have someone, a professional that you're sitting with and going through and having these discussions with you. Portfolio construction is key. So it's important to have a balanced portfolio, and that is not just the investment that you're doing as an individual, but everything else. So looking at your full portfolio is something that is really, really important. So if you've come into me and you said, okay, I want to invest in stock and shares, and then I look at your portfolio and I see, well, you already have investments with First Citizens, or even let's say you work for Republic Bank. Your income is vested with Republic Bank. I have to take that into consideration. Do I now put you more at risk with Republic in terms of having your savings invested in their shares as well? So all of those things are really, really important. A balanced portfolio helps smooth out the fluctuations, and diversification reduces risk. And all that means is within a balanced portfolio, even if you're adventurous, even if you want to take maximum risk, it's not wise to just put risky investments in that portfolio, because you want to get some part of it offering a consistent return, some part of it not always fluctuating. And why a consistent return is important is right here. Fixed incomes give you regular interest or coupon payments over a set period of time. So your bonds, your treasuries, your notes, these give you interest either every half year or every year. And the benefit you get from that is that interest that you're earning is then reinvested in your portfolio. So we can then take that interest and purchase shares. So that is why it's important to have a well-balanced portfolio. And the interest allows you to benefit from compound interest as well, because as you get that interest within that portfolio, it's then reinvested. So again, as I had mentioned before, equity, shares, stock, all the same. So these represent partial ownership of a company, and they offer capital appreciation. So the reason you have equity in the portfolio is that you will get growth from that. So as the businesses grow, as they continue to do well, the value of their shares continue to grow. And on top of that, you also get dividend payments, which is part of the profits that the company makes. So now that you're a partial owner of the company, The years that they do well, they give their shareholders dividends. So you benefit in both ways. So here at First Line, we pride ourselves in taking the time to treat everybody individually and building their portfolios. So this is an idea of what a moderate, well, what a conservative, a moderate, a moderately aggressive, and an aggressive portfolio would look like. So if somebody is conservative, then I would advise them to go into something where they're not seeing fluctuations. Fixed income securities like bonds will give you a regular return. Every half year or every quarter, it will give you a regular rate of interest. So there's no fluctuation in the actual value of your initial capital. If you're more of a moderate investor, then we can put 15% of it in equities and shares. And that 15%, so while you have 75% or 78% of it giving you growth, consistently rates of interest and consistent return, that 15% gives you the opportunity for your actual capital to increase in value as the companies that you're invested in continue to increase in value. But that 15% will allow for small fluctuations, because sometimes the prices, company has a bad year, the prices could potentially go down. If you're a little bit more than a moderate and moderately aggressive, then we increase the equity share of your portfolio. Again, this will increase the fluctuations, but it will also increase the potential for return as these investments continue to grow and do well and pay dividends. And then you have the aggressive return, where we put 40% or maybe a little bit more in equity. So for these clients, they are absolutely comfortable with seeing half of their portfolio go up and down as changes in the markets occur. And with the aggressive clients, it's clients that I know that are going to be there for a long period of time. Those are the ones that I'm encouraged to do something with a little bit more of an aggressive return. All right. So I wanted to give an example here just to kind of tie things up and tie things back a bit of if, for example, you have an income of 10,000. Now I chose 10,000 as an average. I know some people have a little bit less or a little bit more. I chose it as an average based on the little bit of research I did and people within Trinidad in the age group of between 25 and 30. This is roughly what some people, what people get, maybe a little bit less, maybe a little bit more. All right. So I wanted to show you how you could potentially section off your funds to make it work for you. So you have an income of 10,000. You have your expenses. Now I did the expenses based on my experience of what these expenses could potentially come up to. So I'm saying 6,000 is what you should be able to comfortably live on in your food bills, your insurance, your cable, your entertainment. That means going out for a drink on that budget as well, needs to be included, and your handbag and your clothes. It's possible. I've done it before. So that's what I'm basing that $6,000 on. Now, what I didn't put in there, and only afterwards I thought, you know what, I must make sure and say to you guys, a good part of a financial plan is making sure that you're well insured. So when it comes to holistic planning, always make sure that you have the minimal health insurance. And when I was young, when I was 27, I took out a critical illness insurance in the UK, and it cost me only £25 for £500,000 worth of critical illness insurance. And up to this day, that is what I pay for my critical illness insurance. Whereas if I took it out now, 10 years later, it would be a whole different cost. So that is something that I would encourage you to do. Make sure that you're well insured health-wise. Go to your employer, find out if they have a plan and sign up with your health insurance plan. And then a critical illness plan I thought was important. Now, because I have a son, I also have a life insurance plan. So that as well, just making sure that those things are there in the event that you do have a health issue, that you're not, again, needing to dip into this money that you've worked so hard to accumulate. All right. So just as a side note, part of your expenses, insurance is important, just to sort of secure yourself and your financial plan. All right, so let's say that your expenses come to 6,000 and your planned spending, you can put money aside for your planned spending. So planned spending could be anything from purchasing a big purchase like a car to a small purchase like a phone. I remember when I was younger, I would put aside money all the time to do a shopping spree or a holiday. I would say to myself, okay, I'm saving $500 every month because I want to go on my holiday next year. So just making sure that in your plan that you are carefully planning for what you're going to spend in the next 3 years. And then you put everything aside for your actual investment goals. And the investment goals can be anything from 3 years plus. And the right thing to do would be to sit with an advisor who would give you different investment options for the different goals. So the goals for the next 5 years, the investment options that you choose for the next 5 years is going to be different to the options that you choose for retirement and 30 years and beyond. All right, so it's really important to have those discussions. Okay, so we finally come to the end. So now we can do a few more questions. It might. You know what? Oh, sorry. The question is, does it make sense to hold a checking account as opposed to a savings account? I'm going to say that it might, because when I came here, I do not know why, when I moved from the UK, banks were encouraging me to do a savings account. Well, I shouldn't say I do not know why. I fully well know why now. They kept encouraging me. I said, no, but I want a checkings account. My income is going to come. I'd like to be able to have checks and a card. And so it's not going to be a savings account. And they're like, no, it's less trouble. Only to discover that most of these banks actually charge you a withdrawal fee or a service fee every time you use when you use a savings account as opposed to a checkings account. So you need to check with your bank and find out what the fees are, because yes, the fees may make it more viable to keep a checkings account as opposed to a savings. All right, so one question is, when comparing credit unions, is it good to look at the kind of rate that they charge on debt? So if you want to take out a loan. So the person is saying, when you're deciding where you want to put your emergency fund, this is what I believe, let me know if I'm incorrect. When you're deciding where you want to put your normal savings and your emergency fund and your planned spending, when you're choosing a credit union for those purposes, is it worth comparing what they would give you on loans and etc. when you're building that relationship? I would say yes. I would say there's some credit unions that are significantly better than others when it comes to those kind of things, lending. But I would say don't put too much emphasis on it, because rates change all the time. So it may give you a decent rate now, but then when you're ready to take your loan later on, the rate may not be as attractive as others. So my main point here is always shop around when you're ready to take out your loan. So yeah, so somebody just advised that maybe it's best to look at both sides. So you have one, so maybe have two credit unions, one for saving and one for taking out a loan. All right, so somebody asked if you weren't paying it, or if you weren't paying off your credit card before, but for these past 6 months you have, would your credit score improve? So what I would need to understand is, what are you talking about? Your minimum payment? You weren't paying the minimum payment, or you weren't paying off the full balance? All right, so what company offers bonds in Trinidad? First line. We offer bonds. There are other companies that you might be able to find. Now, bonds are not as common as shares. What you will find is every so often a company will come out with bonds specific to them just wanting to borrow for a specific project. What we do here at First Line is we keep our eyes open for all the bonds that are coming out in the market, so our clients benefit from those bonds. I know you guys are signed up to our blog, so we normally do blogs on what bonds are coming out and our little bit of analysis on it, but generally we keep an eye on bonds, because when we are purchasing bonds, we make sure that it's suitable for our clients, and we generally know which bonds are coming out in the market as well. All right, so so you were paying before, so what I understand is that you, this is for the question with the credit card and paying off the credit card. So what I understand from that is you were paying off just the minimum payment before, and now you're paying off the full balance and you're asking if it will affect your credit score. So what I found from my experience with your credit score is that as long as you're paying your minimum payments on time, your credit score will be good. So if you're paying off the full balance, then even better, but it's not even that necessary. If you're paying off the minimum and maybe a little bit extra, so what a little bit extra does when you tend to pay a little bit extra in your credit card, they tend to increase your credit limit because they see you as a valued client, a valued customer who's very good at paying off their debt. But it doesn't drastically affect your credit score by paying the full amount as opposed to paying close to the minimum balance. As long as you're not defaulting on the minimum payment, that's where your credit score will get badly affected. What is a good credit score? So that question I'll have that one I'll have to come back to you because I'm not so versed in the actual credit score here in Trinidad. So I'll have to get an answer for you and come back. So somebody asked in this last page that I have up here with you, how come I didn't include putting aside for the emergency fund? And this is assuming that your emergency fund is down, ready, sorted, secure, and now we're already looking to look at your investment goals and look at growing your money and getting some profit. So this diagram here assumes that your credit cards have been paid off, so you have no revolving debt, and that your emergency fund is always also sorted. What package is it? So somebody asked, what packages do we offer because they need help with clearing their debts? Now, we can have a conversation around it. Generally, what we do is we build an investment portfolio for you. So what I would sit with you and do is go through your finances, go through the amount of money that you have, the amount of money that you're able to save regularly. But in terms of clearing your debt, I mean, I can give you some advice and information, but we don't have any packages specifically detailed to help you clear your debt. Just a quick one with regards to this this slide. If you don't have your emergency fund, you can replace the investment side with savings as opposed to emergency fund. So that's if you're still building your emergency fund. But what I would suggest is before you do any of this, plan spending, investment goal, paying off your debt, start building that emergency fund. As long as you are not behind on any of your debts, you're just making sure that you're up to date and that you're able to pay the minimum, build your emergency fund, and then start to clear your credit card. All right, so I just got a response from Tamara. Thank you so much for Tamara. Thank you so much, Tamara. She works at Scotiabank, and she said, just to add to the accounts question, banks tend to recommend opening both savings and checking account. This is a good option for the person who wants to save. The checking for everyday use and the saving strictly to save. Scotia, in particular, does not charge a monthly fee if your minimum balance is $1,000 in the account. And if the person wants to use funds from the savings, they can use online mobile banking to transfer the funds to the checking account and utilize it from there to avoid any addition. All right, Tamara also informed us that a good credit score is above 700. Thank you, Tamara. So somebody said good information. They hope they can do other things like mortgages, etc. And definitely that's what we're here for. We're here to have those open conversations with you. These are my details. So definitely feel free to call. We may more than likely going to follow up with a survey just to understand what you guys took away from it. Is there anything that we can add further, maybe in another session, that will also be helpful for you? And I really, really do hope that this was useful for all of you. All right, so that's it. Anybody wants to tell me bye? Because it'll be nice to hear from you all. I don't mind hearing some voices.
Thank you very much, Judy.
You are most welcome. All right, guys, bye.